Let's talk some energy, some commodity price movement impact on that sector. As we just talked, BP getting hit on margin concerns. We did hear something similar from Exxon recently as well. Tom White's here with me in studio, host of Fast Market, looking at some options approach to the sector, and joining us from the Hennessy Energy Transition Fund, Ben Cook is a portfolio manager with some stock picks and some thoughts down at our spot at the New York Stock Exchange. Ben, thanks for being here on the show with us this morning. Let's kind of first talk about a theme we were just discussing. BP basically saying crack spreads are getting tricky. We heard something similar from Exxon. Is that going to be a pain point, margins on these producers?
Yeah, I think second quarter operating and financial results will be impacted across the sector. It's not just BP and Exxon, but also a number of the refiners have indicated that refining margins during the quarter were down sequentially, and that will present a headwind to, again, financial results for many of those companies that operate in the refining business.
Your guys' fund, HNRGX, the Energy Transition Fund, up about double the sector for the S&P 500 this year, about double the energy sector year to date. Where is the extra juice coming from? What do you guys got in there that's beating the market?
Yeah, as part of our repeatable investment process in managing the Hennessy Energy Transition Fund, we have the opportunity to invest across both the traditional hydrocarbon value chain as well as renewables. And over the last 6 months or so, we've chosen to increase our weighting towards natural gas equities. We like the companies that stand to benefit from the increased demand for natural gas. It's going to come from the export of LNG, of course, the onshoring of industrial activities here in the United States, as well as artificial intelligence and the natural gas that's going to be needed to fire the electric power generation that's going to drive the data centers that provide that artificial intelligence computing power. So natural gas has done well year to date, and we think there's more upside to come.
So these new hot tech themes are going to be driven by old classic energy, at least for now?
Yeah, we think so. If you think about the growth or potential growth in electric demand associated with artificial intelligence, right now the power grid is being fueled primarily by hydrocarbons. Roughly 60% of the fuel mix that is used to generate electricity in this country comes from natural gas, coal, oil, 40% from nuclear and renewables. But we see continued demand growth for natural gas as a cleaner way of powering this demand growth for electric power that will surely necessitate the build out of additional electric power generation facilities across the country.
What about the solar side and the cleaner energy side that seem to have a big oversupply versus demand last year? It was an awful 7-8 month trade for anything solar related, but I do wonder if the AI boom can kind of capitalize on maybe that to some extent. Do you have to have some exposure in an energy transition fund, or has that whole trade been saturated?
The challenge for us on the renewable technology side has been one of valuation and changing policy. There's no question that renewables will play a growing role in supplying power to the forthcoming need for artificial intelligence computing power needs. But from an equity investor standpoint, it's been challenging. Tariffs and the requirement of certain percentages of components manufactured here in the U.S., it's made it difficult to identify the real winners in that space. And so for us, we've de-emphasized that component in our portfolios.
Got it. Okay, so then back to natty gas, if that's kind of the main theme. Who are the major players there? Anything outside of the kind of top producers? Any golden nuggets you got for us stock-wise that are in the fund, Ben?
Yeah, one name in particular I think will stand to benefit from the increased use of natural gas here in North America is Cheniere Energy, and it's not just North America; it's international as well. Cheniere is the largest exporter of natural gas in liquid form to the global market. And with the expected increase in LNG export capacity to demand that's going to come from global markets for cheap, abundant, reliable U.S. natural gas, Cheniere Energy stands to benefit from those export trends. They have growth plans in place, and the company, obviously with tremendous cash generation, is paying out increasing levels of dividends and just recently announced a boosted share repurchase program. So that's one name, in our opinion, that will continue to do well in an environment that will reward natural gas investors.
Got it. Hey, Ben, real quick on the dividend and the payout side, are these companies going to be able to up what they already offer, or is it enough at this point relative to where risk-free rates are?
Yeah, we think that with commodity levels where we are today in terms of oil, crude oil, natural gas, these price levels are very healthy for the energy sector, and they will continue to allow these companies to generate healthy levels of operating cash flow. And ultimately, that cash will be redeployed to debt reduction and share repurchases and dividend hikes. So where we are in terms of the commodity market and where we see the commodities trading over the next 12, 18 months, we fully expect a significant amount of cash return will continue to be a major investing point for investors considering the energy space. Got it. All right. Thanks, Ben, for the analysis. Appreciate it. Ben Cook. You bet. Thanks very much. Absolutely. Hennessy Energy Transition Fund, HNRGX, up about 10% on the year, whereas just energy in the S&P is up like 5.5 or so. Tom, you're looking at options trades on two of the big ones, Exxon, Chevron. Let's start with Exxon.
Yeah, Exxon, not confirmed as far as earnings goes, but it's usually the same day as Chevron, which is the 2nd of August. So I'm taking that into consideration with this option strategy. You know, the stock's traded in a tighter range recently. We've got the 50-day moving average at about 114.70, 200-day moving average at about 109. So if you expect that range-bound trade to continue here in Exxon Mobil, this strategy takes advantage of it. I went out to the July 26th weekly cycle, so just 17 days to expiration. And I looked at selling an iron condor. We sometimes call this a short iron butterfly, where I'm selling the same strike on the call and put, and then buying wings to make it risk to buying. So on this one, I'm buying the 106 strike put. I'm selling the 111 strike call and put. That's currently at the money. And then I'm going to buy the 116 strike call on this one, creating the short iron butterfly, collecting a credit roughly about $3.30, anywhere between $3 and $3.30. But if you collect $3.30 credit, that's what you can make on it. But you can see here, it's a neutral strategy where you want it to stay within this tight range, and that's between 107.70 on the downside, 114.30 on the upside. So if you expect it to stay within this range that we've been trading as oil kind of consolidates above the $80 a barrel, this takes advantage of that. Time decay, or theta, works in your favor as every day the price of this short iron butterfly that you sell at $3.30 contracts in value as long as it stays within that range.
Okay, so trading Exxon kind of within the boundaries of where it's been lately, not looking for a massive a shift to kind of the trajectory there.
Right.
Chevron, I mean, the chart generally still, they mimic each other.
They do, but it's been lagging. I remember crude oil is up 15% so far in 2024. Chevron's only up 3% so far this year. So it's definitely lagged, not only its peers, but the oil market at this point. So I looked at something a little bit more conservative. You got earnings on the 2nd of August. So I want to take advantage of that higher implied volatility in the option market. And I created a cover call strategy because it's got a 4.25% dividend yield, Oliver. So pretty good, decent yield on that dividend there. So cover call strategy where for every 100 shares of stock you buy, you sell an out of the money call to the upside in here. I looked at the August 2nd weekly options and sold the 160 strike call. You're going to pay about a $152 debit. So you're buying the shares at a discount because you're selling the out of the money call against your long stock. If you paid $152 even, it's trading maybe a little bit higher than that right now. But the debit you pay is also going to be your break even to the downside. So you're collecting over $1 on that short 160 call. So that's creating yield. And then you own the shares, right? So you get to keep that yield. And as you get closer to expiration over the next 24 days, you can roll or adjust that short call repeatedly. That collects credits. That increases your potential profitability and reduces your break-even and risk on this position every time you do that. But a little bit more conservative, but trying to take advantage of yield not only on the short call, but also on the dividend.
Okay, so upping it, taking advantage of the dividend and basically betting against a huge rip higher.
Yeah,
for Chevron.
You got to let that strategy. You got to want to own the shares for that dividend. but then also you're buying it at a discount and it's underperformed peers and crude oil.
All right, cool. Thanks, Tom, for the options trade.